we would have been able to give you for last week's trade ideas. And the reason why this is important is, as Kim rightly mentioned, the idea of benchmarking. It's all very well looking at these various programs and saying, yeah, okay, this is what they're offering, but what does it do for my trading? Well, everybody unfortunately is going to be different, and that's why everybody gets different results, because it depends how much you're willing to put in. It depends what time you've got. It depends what market you want to trade in. It depends. It's not systematic as such. It's not something that everybody's going to have the identical trade in the identical position doing the identical thing, although that is possible if you were to follow some of the system trade ideas that we have, and we do system trade ideas. There's plenty of system trades, and we're going to see a number of the system trades when we look at the week ending the 19th of August. And what we're going to be looking at is a number of the trades that we have time-stamped. And the reason why this is, of course, it's not something you therefore have to take my word for. They're all time-stamped. And the results you will be seeing, of course, are purely based on the maximum swing possible, not what you would have got, but the maximum swing possible. What we kind of suggest to people is that the maximum swing on one contract is usually what you'd expect to make on 3 contracts, for very obvious reasons. The first contract usually is taken out for a first target, the second contract is usually taken out for a second target, and the third contract is usually taken out for the maximum possible target. So you end up with, on average, 3 contracts making what is effectively one single swing, the total from the top to the bottom of the swing. So please bear that in mind. We're not saying this is what you would make per contract, but this is what the maximum swing was per contract. It's the only way you can assess, because everybody's got a different idea of profit taking and stops at break even, which obviously we touch on a regular basis in the classroom. So we're going to take a look through some of these. We'll probably not look at all of them, but on a one contract basis, I was just totaling up some of the ones that we had, the before and the after tweets. So there was a before tweet that suggested an idea, a thought, a process, and a scenario. And obviously there's systematic ways of getting into some of these trades. They're all based on a single contract for the maximum swing. So they're not based on multiple entries and multiple exits, etc. Some of them do have add-ins, but bear that in mind when you're looking at this. That's based on one contract, maximum swing. How much did the systematic trades make as a maximum swing? Now, this is just some of them. This isn't all of them, but obviously by any means. But this is just some of them. How much did the systematic trades that I'm about to show you make last week on a one contract basis? Well, the answer to that question, you may be surprised to know, was $49,300 per contract. Now, that's the maximum swing per contract based on the tweets. $49,300 per contract, maximum swing based on the tweets that we are now going to show you. So the total of these tweets, you don't have to believe me, the total of these tweets obviously are 49,300, and there was a lot more. We didn't include the ones, for example, we had on the sterling markets, etc., etc. Because there was a lot of entries and a lot of exits during those periods. But we'll take a look at some of the things that we talk about in classroom, some of the things we teach in classroom, some of the things that we find, of course, that are important in the classroom. And obviously, when we understand some of the things that are important, we can start to recognize why it makes sense about learning some of these processes. So we had a trade, for example, in the Qs. You'll see that the left-hand side of the chart there, and some of the charts might be quite small for you, but you'll be able to take a look at it regardless. But anyway, if you can't make it out, it says the 11th of August. It's 1:28 p.m. And what we do for people is we teach how to calculate what we call the dealer's levels. We teach everybody how to calculate the dealer's levels for something like the Qs. And we give a top price, we give a bottom price, and we give duration. So we tell how long this trade is valid for. And obviously what happened from that point was, you'll see that going into the following day, the Q traded up to the very high price of 330. It came all the way down to a low price of 323, and then it bounced all the way back up to the high price of 330. 330 was exactly the price that we gave out for the week before. So you can see that the levels are all visible on the 11th of August, And you can see that the following days, what happened was the price traded from and back to those two levels, and the total round turn, the total round trip for that was about $10,000 per contract. So that's pretty good. So the key idea behind those is you've got to know your key levels. So what else did we do? Well, here's a trade here. It might only say $550, but again, it's one of those things that we can look at and we can see what the narrative was behind these tweets. It's not just about trying to find an indicator and saying, well, there's what the indicator said that we should have done, and this is what we did do. Or the trade on the left-hand side, if you look at the trade at the bottom of the left-hand side, it says, my biggest concern for the equity market is the bulls have been focused on some fund business in the Russell, which has been surprisingly bearish even after Friday's superb rally. And what we were talking about at that stage was, obviously, if we're saying we're very, very concerned about the bulls, we're very, very concerned about the bulls rally, it's focused on fund businesses now rotating into the bearish side. We want to be sell side. We want to be sell side only. And what happened next? We had a drop of $550. Now, it doesn't give you a level. It doesn't give you something to lean against. It doesn't give you all of these other lovely signals because you might not be available for those lovely signals. You might be coming in at 1 o'clock the next afternoon or 7 o'clock the next morning or 8 o'clock the next afternoon. So when you come in, you're able to pick up on the narrative and say, right, bearish. How do I trade this? Is the trade still available to me? Can I make money off of this? In other words, how could you use this information? It's not about how I use the information. It's how could you use this type of information? First of all, do you understand what we're suggesting is the scenario? And if you do, how would you be able to think to yourself, okay, I'm looking for that transition opportunity to take advantage of that trade regardless of when I see it, whether I see it instantly or whether I see it 2 or 3 hours afterwards. What about the next trade? Well, the next trade, let me describe the narrative as it catches up. A $2,000 trade, and on the left-hand side, it's got Friday's close, and this is one of those ones where we simply just keep getting oil over and over and over again, and we just keep coming back to the well. Forgive that use of expression, but we keep coming back to the well for more oil. And sure enough, we keep on filling up our bank account with loads of cash. Friday's close with a fair amount of short value still intact, valuing oil at $90, selling from the 92 from the gun with key overhead, usual places at 93, 94, and obviously the 92. This was at 11:23 p.m. on the 14th. Now you might say, and what? Why is that significant? 11:23 p.m. on the 14th. Well, if you look at the very top edge of the chart, you will see that the top edge at $92, the price we've already just mentioned to you, the $92 trades at 1:20 a.m. on the 15th. 1:20 a.m. on the 15th happens to be 2 hours after the tweet. The tweet suggested selling. The tweet said that there was a lot of short value, valuing oil at $90 a barrel. Now that's significant as well. If you look on the right-hand side of the charts, you will see that oil traded from 92 to 90 the very next day. In other words, we tweeted out 2 hours before it happened a sell trade at 92, and we told you that oil was priced at 90 or valued at 90, and within 8 hours, 9 hours later, the oil had traded from 92 to 90. Now that's not good, guys. That is a world-class performance. Goldman Sachs couldn't come up with that one. Goldman Sachs could not come up with that one, and you'd be paying Goldman Sachs $20,000 a month just to sit on their desk, and they still couldn't come up with something as accurate as that. We said 2 hours before the market even traded 92 that the price valuation was 90 and we should be selling it. 7 hours, 8 hours later, the price is trading $2,000 per contract lower at 90. Now, if you get nothing else from that, you look at that and you say to yourself, my God, that's almost impossible to come up with that, and yet it's not. We do it every single day of the week. Now, do we always get it this accurate? No. Do we claim to always get it this accurate? No. But it's part of that scenario building process. And obviously you can see that this is not a one-off. You saw the $10,000 rotations on the Qs. You saw the S&P trade. Now you've seen an oil trade. And then when we catch up with this one on cable, this is one of our systematic trades that we talked about last week in the classroom that we were doing in here. And we talked about being able to get that cable trade on using a systematic entry. And that systematic entry was 7 times return on your money. So if you invested 1% on your trade, you made 7%, 2%, you made 14%. So whatever that means to you as a trader, getting the systematic entry process, you can see that we used that red candle right there. We put the stop 1 tick above the red candle. The level is the level that we talked about last week, our RGL on cable, and you can see that the price had one sell off from that price area and then a second sell off from that price area, 7 times your money. If you're unlucky, 7 times your money, because there's been more than one entry that you could have taken full advantage of. Crazy, right? So whatever 7 times your money means to you, that's what you would have made in that trade potentially. Okay, so this is bonds. Again, this is our old friend Max. And Max does it for you. Max obviously is a program that we are very close to finishing on bonds. We've got it live testing. It only started live testing on Friday. It had one trade, one very, very large winner. But it's basically the idea of benchmarking. Kim introduced this particular class as a benchmarking process, and I want to touch on benchmarking before. We will do a classroom, by the way, but it's very important that you guys actually have this idea of belief, because to me it's it's all very well being involved in trading, and trying to get involved in trading is pretty straightforward. You just pays your money and you take your chances, but when you actually really come down to it, it's that belief. We had a chat with one of our clients in the room last week, and the chat was basically along the lines of having that confidence to press the button, seeing the trades but still not having confidence, and that's where it really comes down to. You have been led down a garden path for years and years and years. Some of you for decades, even thousands, tens of thousands, hundreds of thousands of dollars in fees and courses and books and videos and YouTubes, and still nothing is consistent. That's because nothing in the markets stays consistent. There's always changes. There's always things that are developing. There's always narratives that not quite the same, and that's because every day we come into the markets, there may be a new driver. And if you're using a purely systematic approach to trading, that new driver might not work today. I'm sorry to tell you, it might not work today, but if you're good enough at trading, if you're a professional, one of the questions you ask every day when you walk into the room is, what's driving my market today? And that's what Max does. Max is obviously based around commercial operations. It's volume and value at price, volume and value at price. And when Max finishes an accumulation phase, what you're looking for is the first candle going in the direction. And that means if it's green, you want the first candle dropping to buy into. And you can see that that trade went for a $1,000 swing without even blinking. It went from 153.20 to 154.30. It was well over $1,000, by the way. We're rounding down quite significantly on this trade, but $1,000 swing without even blinking on that. And Max is automated, and obviously we're just about to kick this out the door to our clients, and it will be your clients that will get this program if they want to trade bonds, oil, and indeed equities going forward, and eventually possibly even Forex. But we're getting very close to the bond outcome. It's as I said, it's now live trading for us, and we've only done one trade on Friday, and it was well over $1,000 profit on that one trade. But it is what it is. It's not the most popular in terms of the number of trades that it does. That was the 15th of August. Let's get on to the next trade. This is one of those perfect benchmark examples of how much money can you make almost trading blind. And one of the things you'll be able to recognize here is, number one, take a look at the date of the tweet, 15th of August. RGL 89.40, 89.60. RGL basically means we are expecting a volatility expansion trade, or sometimes we just refer it to VEX. Volatility expansion from these prices. In other words, it's sell side below $89.40, buy side above $89.60, and you should be able to make a lot of money. Well, you can see that the market broke below $89.40, and obviously the trade went all the way down to $88.40, and it simply was absolutely perfect. $1,000 already recorded, and it was as easy as that. Now, obviously, when you enter these types of trades, there's a lot of different ways you can manage them. You can put stops at break even. You can take plus 10s. You can put stops at break even minus 10 to make it plus 0 or plus 1. You can take 100 ticks profit. You can take a 10 tick profit and stops it. There's a lot of different ways, and everybody's going a different way. And a lot of people say, but what way do you use? Well, that wouldn't be very relevant because I work for a bank, so we do a different trade to you guys. What we're giving you is the opportunity to say, no, I could use that information based on the way I like to trade, based on the way I like to enter a process. And if you don't know how you like to enter a process, well, we teach you that as well. We teach you lots of different ways to suit your style and to suit the software you've got so that we can actually get you using the stuff you've already spent a lot of money on. You're not having to buy more stuff unless you're wanting to buy more stuff. And we'll introduce you to stuff that actually has real value, stuff that actually you will use to find some great trades for things like transitions. Let's move on. The final outcome, by the way, of that trade that we've just looked at was huge. You'll see what happened to that $89.40 trade. It actually traded all the way down from that $89.40 to $87.80. I mean, it's not quite $2,000 per contract, but you can see it's the same trade. And because we're able to eliminate the buy side of the market, we're able to focus our attention on the sell side. So if you're joining us, say, for example, later on in the US session, and you say, well, but I'm nowhere near $89.40, and what? It's still sell side only. So what are you going to do about it? Well, I'm going to try and find a way into that trade. Okay, do you know how to get into that trade? Well, I'm looking for a level 2. I'm looking for a Heisman trade. I'm looking for a tipping price. I'm looking for a BSG squeeze. There's a lot of ways to get involved in trades. You don't have to get that price, and that was your only price. In fact, we encourage people to trade and trade a lot and trade often so that they get a lot of experiences and they get lucky so long as they know how to trade. It's very important because when you trade a lot, you get over this habit of being nervous about trading because it's more being nervous about not trading. You want to be in trades. You want to be doing trades because that's what the hell you're here for, right? If you're here to make money, you're going to struggle. If you're here to trade, this is where you trade. Now, what happens is the better you get at trading, the more money you will make, but that's obviously the outcome of getting more trades done. You can't make any money if you haven't taken any trades. So we've got to get people over that habit of not having the confidence to press a button in the first place. And we always suggest that you reduce your sizes significantly to what you're trading, and in fact, change your trading change your trading market. So if you're trading a market that's too expensive for you, like the treasury bonds, change it to something that you can do a lot of trades in to get experience of trading without costing you a lot of money in terms of losses whilst you learn. $1,600 on that trade. Take a look at the next one. This is gold. So for anybody that likes the occasional gold bug opportunity, this is gold. 10:15 a.m. on the 16th. 10:15 a.m. on the 16th. And you can see that we went through a lot of opportunities. This is something that the original tweet was at 9 o'clock on the 15th of August. The tweet is in the box. And we gave you the RGL. RGL, 97.5, 98.5. It's buy side above, sell side below. Guess what? That's dead easy, right? Buy side above, sell side below. If the price stays below this, you're looking for systematic entries of gold below that price. What happened? The first trade got a $550 swing. The second trade got a $900 swing. Take those two trades, $1,450 swings from those two trades. Now again, there's a lot of different trade entries. There's a lot of different ways of managing those trade entries. There's a lot of ways you could look at and say, but nobody gets 1,450. You're right. You're absolutely right. We're not claiming they do. We've told you this at the beginning of this little session. We said this is the maximum swing. It's not what you would expect because everybody's going to have different profit and loss targets and various other things. And yes, we teach some systems to try and use your profit and loss targets and manage out an open position. The one thing we try and get people not to use is a thing called a trailing stop. It's a horrendous product. It is a horrendous product. Institutional traders do not use trailing stops. In fact, institutional traders generally don't use stops. They manage out a position. They take responsibility for managing out an open position based upon developing value, not some rigid, robust system of simply, it's got to do this or that, and that's it. That's not very professional. If the market changes, you change. Simple as that. So this was a very nice $1,400 swing on gold provided to you the day before. The day before. So you're able to look at that and say, right, if it stays below this, I want to be sell side. I don't have to try and buy bottom edges. I just have to make sure I book my profits. If it goes above this, I'm going to be buy side. I don't have to be sell side if it goes above. I just use that to book my profits. Could you see how easy it is to use this type of system if you go through this process? You're looking at these as one side only type narratives. Here's an S&P swing. This is on the 15th of August, bearing in mind that this is the week beginning the 15th of August, guys. So the week beginning the 15th of August. And we're still on the 15th of August, so you've already had all of these trades before the end of that day is out, already, right? You see how many trade opportunities there are? So the S&P, RGL, 42.99, 42.99 and a half, buy side above, sell side below. And there was a number of opportunities the night before, and then into the 16th. You can see that the actual sales that we've got highlighted on this, that is dated the 16th. This tweet was sent out on the 15th. So it was sent out on the night of the 15th. We gave you the prices. It came into those areas, sold off, came into those areas, sold off. Thousands of dollars in profits using this type of idea. Thousands of dollars. Now, not everything is about simply these buy-side, sell-side levels, because sometimes we come into areas and we're asked to and demanded that we make a decision, demanded that we start recognizing what a good benchmark looks like. And we're going to be touching on that when we look at entry processes and types of entries that we can look to trade. But here's another example of that volatility trade. Remember on the earlier tweet, the very first tweet we sent was the Qs. We looked at the Qs, we looked at that $10,000 rotation. Well, this is on a product called TLT, which is a fund that tracks the bond market 20 years out, and it tracks the bonds 20 years out, so effectively the equivalent of trading the ZB contract or the UB contract. And this is what we actually saw happening. You'll see the tweet was here. It was the 15th of August. It was 11 o'clock at night, London. And then you can see what happened the very next day. We gave you the two price areas. So the shaded area was where we told you that we should be looking for buys. The shaded areas was where we told you should be looking for sells. And the very next day, the price bounced literally off that same shaded area. Just check the tweets. Check the timing of the tweets. This is not fabricated. This is not made up. It's all there, time-stamped, guys. It is absolutely straight up. The tweet was 14 hours before the price opened the next day, traded to that level, accurate to about one single tick, and then it rallied $1,700 per contract on the UB contract. $1,700, guys, with an accuracy of about one or two ticks. Now, do we claim it's always a buy trade there? No, that's not the point. What we're saying is you should have been looking at the possibility that was going to be a buy trade there, adding it all up, trying to figure out why that was such a great buy trade opportunity, and then executing if you're delighted and happy with the benchmark that is taking place there. Could you see yourself being able to see that level, find that trade, and take $1,700 per contract out of the market, knowing that this is the key price? 14 hours before it happened. Is that enough notice for you guys to be available at your screens in the event that that trade opportunity presents itself? Is there enough notice? Because some of the tweets obviously give you about 1 minute's notice. we are currently working this buy or this sell. That's obviously something that we do. Sometimes we'll send a tweet out, we are currently working a sell, and if you decided to join us, you'd be in the same trade as we are doing right now. And a lot of tweets are something about the future. This is about the future, 14 hours into the future. Think about the difference between this and the Elliott wave. Think about this, the difference between this and stochastics. Think about the difference between this and RSI. We're actually using something in the future, whereas the RSI, the stochastics, the MACDs, they're all looking at something that happened 20 candles ago to make some sort of a ridiculous assessment that the market's going to do something similar 20 candles later. This is the reality of the markets. This is the reality of real-time market-derived pricing by the people that get paid the most, by the people that know the most, by the insiders of the marketplace. And we use that and we can find that information for ourselves free of charge once you learn this stuff in the classroom. Let's see what else we've got for you. What about this trade here? Now, this trade made $1,800 maximum swing, and we always claim that we are the best oil desk on the planet. That's not even up for debate. If you want to pitch any oil trader against us, even from Goldman Sachs' best oil desks, we'll take them up and we'll spit them out. And that's probably most of the guys in the room as well that trade oil on a regular basis. We are the best oil desk by a country mile on the planet. Almost perfect. Look at this. Oil, 10:12 p.m. on the 16th. On the 16th. Why is that important? Because the trade takes place on the 17th at 7 p.m. So in other words, 9 hours later, 9 hours later, the trade takes place. Now, you may be saying, wait a second. You've given us a price here of 87.80, 88 evens for pending sellers. So we're telling you there's offers at this price. The price never traded 87.80s. You're right, it didn't trade 87.80s. It traded 87.70s. It was 10 ticks shy of 87.80s. But look at the time of the morning. It's coming into the pre-Brent market. The decisions are going to be getting made in the next hour. 7 o'clock in the morning through to 8 o'clock in the morning is the Brent market open session, of course. And obviously that's London time, so that gives you an idea. So coming into that session, if we're not going to get 87.80s, we're not going to get 87.80s. This was obviously made, this tweet was sent out 7 hours, 8 hours, 9 hours beforehand. There are some micro adjustments, guys. I'm sorry. We don't get it to the tick every time. There are some micro adjustments, but would it still be useful knowing that you had pending sellers at 87.80 coming into the Brent market and seeing a rejection of the 87.70s and going, wait a second, Ray's got pending sellers up there at 87.80s. We're trading 87.70s. Let's get this sell done. Let's get this sell on the books now. Let's go. And you're selling off the 87.60s, the 87.70s, a couple of level 2 rejections. And by the time we reach the 9:30, which is really only, well, you can see 2.5 hours later, we're sitting on $1,800 a contract, guys. $1,800 per contract. Again, we're not telling you that it's a trade, because obviously this is done hours in advance, 7-8 hours in advance. We're not telling you that it's a trade, because when it gets to that price, you've still got a decision to make, but at least you know what you think the decision should be. You're starting in an educated, informed location. And that's the key. The only people that make money in the world of gambling, the only people that make money in the world of trading is what you call informed traders. And I think that's probably a widely accepted and acknowledged fact. The informed money makes money and the dumb money doesn't. And obviously there's a lot of dumb money out there. And there's a lot of informed money. But the informed money doesn't trade everywhere. The informed money finds these benchmark locations to try and trade from these benchmarks. And what we're trying to do is get you guys into that informed status. You're informed. You're not trading in the shadow of the informed money. You are the informed money. You become the informed money in this classroom. You know what you should be looking for, when you should be looking for it, and when you see it, you take action. You take action. So that was another $1,800 on that perfect trade there. Let's take a look at this bond trade. Now, this is one of the things that we like to have a discussion about. When we have a discussion about these bond trades, the idea, guys, is that you start to become the guy that's involved in the conversation. You're not the guy that just listens into the conversation. You're the guy that's actually in the conversation. You're committed, you're already involved, and you're knowledgeable about the conversation. If you look at what we're talking about on bonds, at 10 p.m. on the 16th of August, we're caught between inflation break-evens and curve flatness. Now, some of you might know what that means. Some of you might not have a clue what that means, but that's why you would come into the classroom, because you're saying, okay, but what does it mean? I know what curve flatness means. I know what inflation break-evens mean, but how do I use that to find trade opportunities? And then we go on to talk about the inflation break-evens. We talk about curve flatness. With bids back on oil and holding, we can look for bond shorts. Okay, look at the narrative, 10 o'clock at night. We can look for bond shorts into the London Open. I wonder if that's clear enough for you guys to maybe be able to make a decision around what to do at the London Open. I wonder if you can understand that we are looking for bond shorts into the London Open. Is that clear enough? Is it ambiguous? Or is it crystal clear what we're going to be looking for? It's crystal clear. Now, obviously, if some of the narratives that we've just been discussing change, if the inflation break-evens change, or if the curve changes, or if the oil price changes, for example, well, the trade isn't going to be a short into London, perhaps, but at least you now know what to look for. You're able to come into the London Open, check what's happened, and say to yourself, okay, Ray said basically if nothing's changed, if there's no dramatic differences, that he's going to be looking for bond shorts at the London Open. When's the London Open? Well, we normally kick off the London Open around about 6 o'clock onwards. So we start trading some fixed income assets at 6 o'clock onwards, usually 6:30, 7 o'clock onwards. And we start trading the trade. Now take a look at what happened at 6 o'clock onwards. You can see for yourself. You draw a straight line over the Asia session highs, and then you're already reading my tweet saying we can look for bond shorts into the London Open. We can see that the value is just as good as it was, the purple line. The value is as good as it was, so there's no change to the main driving values. And we sell it. We sell it, just as we promised we would, assuming the various elements of the bond curve remain in play. And you can see that if not, I'll be avoiding bonds. So if it was changed, I'd be avoiding bonds until it reestablished some value. So in other words, we don't just give you stuff. We teach you genuine stuff that is there for a lifetime. We teach you how to understand the bond curve. We teach you how to understand the Fed. We show you how to do your own dots plots. Before the dots plots come out, it's dead easy, in fact, to do your own dots plots. And that dots plots is based upon market-derived information. You can come up with exactly the same dots plots, but yours is more accurate because yours is derived from the market. And a lot of people say, but, and what? Because when you understand these things, trades like this become doable. Not because of my tweet, but because you look at my tweet and you say, I don't understand that, but I want to make sure I do understand it before I move on. It's a lesson in its own right. What does he mean by inflation break-evens? What does he mean by curve flatness? What part of the curve are you looking at? What do you mean by the bids back on oil and holding? Why is that important? Well, we go through all of that. That's the point. We don't just give you a point and shoot and say, right, there you go. You learn stuff. You actually learn what real trading is about. None of this is lagging. It's real. It's the conversation stuff that you see on every bank desk on every single morning of the week. The conversation stuff. The stuff that you can look at and watch Reuters news and say, I know what that guy's talking about. The curve flatness and the sell on fixed income. I was already selling fixed income. So when they talk about dealers were telling us that fixed income were offered this morning, you were the offer. How good is that? Instead of hearing something and wondering what the hell it was all about. You actually were the offer. You were the guy that was selling the bond shorts into the London Open as tweeted 7, 8, 10 hours before it even happened. Unbelievable. And we're only on the 16th, guys. We started this on the 15th. You've now seen thousands of dollars worth of trades, and we're only up to the 16th. Now, this is the idea of benchmarking the trade. These are all benchmarks. These are all trades that have a benchmarkable quality about them. We talk about key references on things like the S&P. We talk about key references on bonds. We talk about key references on oil. The idea of knowing where a key reference was. You'll be able to take a look at what happened to this discussion. This was obviously live in the room, because these are some of the things we do in the room as well, as we break off from trading for 5-10 minutes. We do a key reference. We talk about why it's a key reference. We send out a tweet from the screenshots so that people have it on record, so they can see what it did before and what it does afterwards. And this was obviously a live trade at 3 o'clock on the 17th. You can see the time. This is London time, obviously. We're now 30 minutes into the US cash market open. And then you can see on the left-hand side, you can see that we came up with a key reference. We drew the box. We drew another box. And this was at 3 o'clock on the 17th. Well, look at what happened just after 3 o'clock. So in other words, around about 3:05. In other words, what, 6 minutes later? 7 minutes later, perhaps? 7 minutes later, the price came into that key reference, which we'd obviously been discussing in classroom. It came into that key reference, pinned, turned around, and immediately sold off. And it didn't just sell off. It sold off for $750 per contract from that trade. It took approximately 10 minutes. 10 minutes, $750, guys. That's an awful lot of your fee paid already, isn't it? One trade, $750 per contract, from the top of that box to the bottom of that box. And we already had referenced it with the key reference. It's all right seeing this. If you saw this in hindsight and you said, yeah, but how, why did you have that before it happened? It's all very well seeing a double top or a double bottom after the event. And we very rarely just trade double tops and double bottoms on their own because of the nature of the beast. But we're actually showing you that we tweeted it before the price even pinned into that key reference. And we called it a key reference, not for any idea that we would just delete the tweet if it didn't work out. We don't delete tweets. That key reference was on your charts 5, 6, 7 minutes before the trade pinned and then sold off for $750. Play 2 contracts in that one, guys. You're $1,500 better off in one trade in 10 minutes. People say about the cost of courses. Yeah, I get it. Courses are incredibly expensive considering the amount of crap that an awful lot of courses teach. For the amount of value you get in these courses where you learn 1 or 2 setups, which for some reason, that's what everybody's involved in, is, I want to learn setups. What? What do you mean a setup? A setup sounds as if it's systematic. A setup sounds as if it's some sort of thing that a robot can do, some sort of AI can do. What the hell's the point of you existing if that's the case? Markets have never been that way. But in the right location, the right time, doing the right things, doing the right elements, you can find the same type of systematic setup, if you want to use that horrible word. You can find that benchmark in those areas. Say, there's my transition. That's the one I want. That's the trade I want. And you can take advantage. And a 2 lot in that, guys, that's you paid a massive chunk of your fee going forward, right? That you paid a massive chunk of your fee going forward. One trade, 10 minutes in the market, guys. Is that value or not? I think so. Take a look at this dealer inventory level. In the oil markets, we'll teach you about dealer inventory. And we can see that from the tweets. Take a look at the time on the tweet. Now, it says 11:50 a.m. You guys know the dealer inventory level hours before that because we teach it just when I get round to sending out the tweet. But take a look at what happened after the tweet. So even if you didn't know the dealer inventory level, take a look at what happened after the tweet. The dealer inventory is one of our RGLs. It's buy side above, sell side below. Now take a look at the price, 86.15 to 86.30. Take a look at the right-hand side of the scale. You will see that the dealer inventory is 86.15 to 86.30. You can confirm that the dealer inventory level, that shaded area at the bottom of the graph, is the price that we've quoted as the dealer inventory. We can see the time which we quoted it at 11.50, and you can see what happened in this area. We had a buy side bounce, another buy side bounce, another buy side bounce, another buy side bounce, another buy side bounce, and eventually another buy side bounce. Another buy side bounce, another buy side bounce, and eventually another buy side bounce. Now, I didn't count up all the buy side bounces because, well, you would have started to become disbelieving that the dealer inventory can be quite this powerful. But when you look at that, you can say to yourself, wait a second, if I just took those buy side reversals, whatever a buy side reversal setup means to you, you would have made a maximum swing of $6,500 per contract. Now, yes, it took 6 hours, but if you're able to buy off of that area 6, 7, 8, 10 times perhaps, and get into trades knowing it's buy side above and sell side below, you can see that giving you that confidence to say, if it's above this price, I want to be long the marketplace. I don't want to be buying top lines, but if it keeps coming back into this area, I want to keep connecting to this as a possible deal. I want to keep getting involved in this as a possible deal. $6,500, guys. We're on the 17th of August. All of these tweets took place between the 15th, the 16th, and now the 17th. That's 3 days. How many thousands and thousands and tens of thousands of dollars potentially could you have been making by now? You hear Laurie's numbers that Kim mentioned in the introduction, and then you suddenly think, here, Laurie needs to get her finger out because she's way behind the curve here, right? And yet she's doing an incredible job. But that's because you don't have every market. Not all of you trade oil and bonds and the S&P and the NASDAQ. So you've got to remember that you've got to focus on one of these markets. You've got to really try and focus on the market that interests you most rather than thinning yourself out to all these markets. So Laurie's numbers are outstanding. Absolutely outstanding. And they're world class. There are very few traders, if any, in Goldman Sachs. Goldman Sachs, guys. And they're paying some of their traders millions of dollars. Very few traders that could match Laurie's performance. Very few. You might be saying, but that's because they're trading massive size. It's a lot harder. Yes, you're right. It's a different style of trading. It's a different idea. But knowing where Goldman Sachs are getting in, Laurie's stepping in with them. Laurie's stepping into their trade with a smaller size to take advantage of the benchmark that comes from knowing where Goldman Sachs are going to be benchmarking an oil trade. So this dealer inventory is one of those benchmarks. Being able to lean against those areas, being able to find those transitions in those areas and take advantage of them. And yes, there's more. Oh yes, there's more. So we had the TLT volatility, we had the SPY volatilities as well. You can see that we had the SPY before and afters. The SPY bounced right off for $2,000 a contract. The bonds ended up giving us a $2,200 rotation. $2,200, a $2,200 rotation, a $3,000. That was a $7,200 total rotation off of those key levels per contract. Take a look at this comment here by Bonds. And again, this is a narrative. And a narrative is about the things you learn as a trader, the elements, the language that you use as traders about why a trade is a buy or a sell. Bonds, 10:49 p.m. on the 17th of August. 17th. Bonds, curve tonight seems more inclined to be bid from the lows in the short term. The macro is still bearish, which means we can see, obviously, which is what we saw causing today's US session rotations. But obviously, the main idea for us is bid from the lows in the short term for the time being, right? We know it's bearish macro. So we know where the bearish macro is. It's going to be at the top lines. So we're going to be trying to bid the lows. Does everybody get that from the tweet? It's important that you do because you're taking my word that that's what it means. But I hope you would think that that's what you would anticipate the trade to be as well. And anticipate's the right word because at 10:49 on the 17th of August, you'll see that the actual trade came at 12 o'clock, roughly 12 o'clock, on the 18th, midnight on the 18th, which is 2 hours later, or 1 hour later, and you can see the next trade came in on the 18th of August at 8 o'clock in the on the morning. 9 hours later, 9 hours. By drawing a straight line along the bottom edges, would you agree that that is the lows? Well, there isn't any lower low than the low, right? That is the low. So if you read my tweet again, and you say to yourself, what does it say? Bid from the lows in the short term. Okay, so you come into the London Open, you read the tweet and you say, right, we're bidding from the lows. Okay, I'm getting a low price here of 52.5. How can I get into this deal? Where am I finding the benchmark? Where's the transition? You will see that during the morning session, an hour or so later, we went from 52.16s to a high price of 53.06s, plus the overnight trade as well, which did exactly the same. $750 in profit on 2 swings, $1,500 in profits on those 2 swings if you got both of them. Pretty good trade again, right? Pretty good trade. But again, it's that narrative. It's about understanding the narrative. One of the other things that we teach is, and one of the key aspects to this whole classroom is we teach you what the market, the truth of the market is. One of the things that we said was we talked about the market makers, and we talked about how to read order flow properly. The guys will probably remember this because this was a live trade call. This was a live trade call, okay? That's why it's not the biggest winning trade you've seen tweeted, but I wanted to show you this because this was a live trade call that most of the guys will probably remember. So we were doing a classroom on liquidity, and I showed them a very, very easy to read piece of information that comes from the order flow side that tells you how to trade the market, whether to be bullish or whether to be bearish. Now, if you look at the oil tweet, and you'll see there that there's a 2-to-1 bullish. So I'm suggesting at 232 that the market is a 2-to-1 probability of going up, 2-to-1 probability of going higher at 2:32 p.m. on that day. You'll see that the circle that I've got at the bottom of the chart says 2:32 p.m. So it's the same time, it's the same date, and therefore if I put an arrow in at that price on a 2-to-1 bullish, the price went from $89.50 to $90.20 over the course of the next 15 minutes. So being able to pick up on a piece of information, just a random piece of information from the order books, and being able to come back to the guys in the room and say, look, here's how it works, and I'm going to tell you, and I'm going to commit to this by time-stamping it, right? I'm committing to this. What I'm telling you is, know this stuff because this is what works. This is what has worked for centuries. This is what's worked in the last few decades. And this is what works today. This is the kind of thing that gives you edges. The ability to read the markets properly, asking the right questions of order flow, liquidity. So when I know that there is a 2-to-1 chance that the market's going to go up, I'm a buyer. And I make $700 per contract in 10 minutes. It's crazy, isn't it? So do you have that confidence when you look at your charts, when you're looking at your stochastics and your RSIs? Do you have that massive confidence to be able to put it in a tweet, timestamp it, and then put live money on the trade? Do you have that confidence? Because that's what we teach. We told the guys, we're 2-to-1. This price is going to go up. Make no mistake about it. And sure enough, if you look at the timestamp and if you look at the price, you'll see that it ties in. It's not photoshopped. You'll look back in the tweets and you'll see that this tweet exists. No change. It's where it is. And you can see that the price goes straight up for $700 per contract in 10 minutes. Again, a massive pay forward into your ability to increase the size of your account, into potentially increasing the scope of your account into some other markets as well. Let's see if I've got any more. Remember, this is still only the 7th. This is the 18th now. This is a live tweet. And this is what I said about the trades that we do that aren't necessarily in advance. Well, that trade that we've just talked about in oil was a live trade. You can see that the tweet was at 32 minutes past, 2:32, and the trade took place at 32 minutes past, right? So it was a live tweet with a live trade right on the right-hand edge of the charts. And this was another one that's on the right-hand edge. Look at the difference in the narrative. It's not about the London Open. It's not about selling the swing highs or selling the day lows. It's about actually working the short side. So take a look, bonds, still working the short side. Not, we might be working at the London Open if we're at the swing highs. We are working the short side. In other words, this is a live trade call. This is a live trade we're doing right now on the right-hand edge of the charts at 12:30 on the 19th of August. Well, you can see that that part is exactly where the arrow is on the left-hand side of your charts. That is exactly where that arrow is. That tweet goes out at that point on that chart. Well, look at what happened next. Forget the arrow halfway down. That doesn't mean anything because obviously that's a different trade. But look at what happened to the live trade. It went from 153 break to the upside, and it traded all the way down to 151.20s. It was a profit of $1,250 per contract swing if you took advantage of that live tweet, which wasn't a forecast, as I said. It wasn't something in the future. It wasn't something you had to look for. It was a live tweet saying, get involved in this. In other words, the last two trades that were live on the right-hand edge of the charts, if you took the minute you got the tweet, you made $2,000 per contract in 2 days. $2,000 per contract in 2 days if you took the tweet at the second you saw the tweet, or the minute, or the 2 minutes, or the 5 minutes later that you saw the tweet. If you took those trades, $2,000 per contract in 1 day. In 1 day. And some people say about price and about cost of learning this stuff. You've got a lifetime of this stuff ahead of you. A lifetime. S&P, RGLs, 42.88, 42.89, now on the 19th of August. Now on the 19th of August, look at the top line, 42.88, 42.90s, right? $1,400 maximum swing if you sold from that price, knowing that information in advance. 42.88 sell side. That was at 12:31 a.m. on the 19th of August. In other words, just after midnight. And look at where the sell trade came in, guys. 1 o'clock Tokyo Open. Half an hour later, half an hour after the tweet, the price pinned off of 42.88, pinned off of 42.88, and then dropped to 42.62. A maximum swing of $1,400 per contract. This is the tweet. This is the max trade from the top edges. You can see that we had 3 max trades. The 3 red bars are the max trades. This is when we use max to find the maximum volume and value at price. So we look for the maximum volume and value at price. You can see 3 trades for max, sell side, and sell side. The top line sell was at 154 basically, and the bottom line went through the 152s basically for $2,000 maximum swing per contract. And you can see again 3 trades, 3 very, very straightforward winning sells. Let's take a look at some last ones just to finish off. Now this is an interesting trade because again we try and get you guys to understand that it's not about buying and selling top edges all the time. And that's very, very important because when we're doing classrooms, we talk sometimes when the price is coming down into lows, we sometimes get people to think about, is the price going to squeeze the lows, or are you going to be that guy that tries to buy the double bottom? So we try and give you a live example of a trade here. RGL sellers had a nice day from Tokyo. That was that $1,400 sell that we talked about. Gap fill longs took us back up to the major 42.70 key. Sentiment, however, is bearish. You see that? 9:07 a.m. London on the 19th. The sentiment, however, is bearish. Well, this is where we've got marked on the screens here, this big upright red line. You'll see that 0907, okay, 9:07 in the morning on the 19th. So that's when the tweet goes out. And we're saying sentiment is bearish. It was easy enough to sell some level 2s at the top edge at 68.5. However, look at the final sentence of that little, or look at what happens after the comma. Still short and expecting a low retest. In other words, what we're telling you there is do not dare buy this bottom edge because we are going lower for that low retest, which was down at 42.60s. In other words, it's not just about technical structures. It's not just about patterns, the way that some of the, the vast majority of books that you'll buy are about pattern trading and about learning about this stuff in terms of patterns. But there's a short at the bottom edge, we're now telling you. A sell at the bottom edge. We are still short and we're expecting a low retest. Look at what happened next. It went from 65 down to 59s and you made $300 profit. That's a live right-hand edge trade. You see that from the timestamp, the 907 tweet, the 907 price, and then the price that takes place up to 920, which is about 15 minutes later. $300, guys. Another massive dent in your cost of the program. The cost of the program getting covered by real-time executionable trades. These are mostly called in the room as well. Bear in mind that we talk about them in the room. We take screenshots and then we post them on Twitter because of, obviously, we're trying to make sure you remind you that these are the things we're talking about. That's why it's a support function for the room itself. It's a support function so that you guys can see what we're talking about. We take screenshots, we put it in there, and you guys go, I remember that trade. Yeah, I took that trade, actually. I was able to get involved in that. But I also know why you said that you're still short and why you're expecting a low retest. That's the important thing. And I think that's us. Yes, it is. That's us on that particular narrative, guys. So obviously you can see that that's pretty much like a week's worth of tweets, a week's worth of information, nearly $50,000. What we've looked at there, guys, for 1 week is about $50,000 per contract of tweets. That's how much that series of tweets has been worth just on their own. Maximum swings, maximum swings. Do you think if you found just one of those trades or two of those trades a week, that this would justify this cost and many more costs going forward without even blinking about the cost of this type of classroom? Of course it would. So when we come down to benchmarking, one of the key aspects is understanding some basic ideas of structure. And I wanted to touch on this because we're going to be talking about the tipping point, for example. Now, when we think about some of the basic class aspects of getting involved in trades, it's very important we understand some of the very, very simple arithmetic behind market auctions. And I just put together this very, very quickly because I didn't have a lot of time today to get prepared for this, for personal reasons. But I didn't have a lot of time, so I had to come up with something very, very quick that we could just throw in and show you what we were talking about in terms of things like the tipping point. The tipping point is looking at the concept of who is in what position at what price inside of a balance area. So for example, if every single trade at every single tick higher results in one trade, in other words, there's a buyer and a seller for one contract, right? So there's a buyer and a seller at every single one of these prices for one contract. What's the total profit and loss during this rally, fall, and reverse rally? Well, you can obviously work that out. We start out at the bottom edge with one contract and it rallies by one tick. Well, obviously the bulls are up +1 and the bears are down -1, right? Well, that's pretty straightforward. I think we can all agree that that's what you would expect because obviously it's went up one single tick, hasn't it? So that's good news. So we've obviously got a very, very simple way of being able to look at the markets and you can start saying, okay, +1 for the bulls. We move up another tick. Now the bulls are up +3 because we've now got two buyers. The last buyer, we've got three buyers. The last buyer's making no profits. The last seller's making no profits. And obviously the two buyers before are now making 2 ticks profit plus 1 tick profit is 3 ticks profit -3 for the bears. So you can start to see that we go from 1 profit to 3 profit to 6 profit to 10 profit to 15 profit as we go up this line. Okay, so the bears are obviously under a lot of pressure now. We haven't taken any trades off. We're just compounding this as a trade. And as the price flips back over, you'll see that very, 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 very quickly, a lot of people think the bears go back into profit when we reach back down into the bottom edge, but that's not true, is it? The bears actually go into profit as soon as we get back to halfway, which obviously when you think about it does make perfect sense, because there's now more volume at the top of this bracket than there is at the bottom of this bracket. So by going back to the halfway stage, you can see that just by going down those extra 2 ticks, The bulls are go underwater by 5 ticks and the bears go into profit by 5 ticks. This is obviously part of that market maker's model that we talked about last week. The idea that the market makers only have to go back halfway to get their money back. Because who's the negative? Who is the bear's position? Who is the guy that's taking this minus 15 contracts? It's the market maker, right? Because the market maker is the passive seller. During this rallying phase, the market maker is the passive seller, and therefore it's the market maker who's underwater by 15 ticks. So the market maker only has to go back halfway to get their 15 ticks back, and in fact, make a profit. Hence the reason why the half-back trade is so important in every single swing we see. Now this is also important because if the price turns back by one single tick, you can see that very quickly, the top edge retest starts working very aggressively against the bears. In other words, a failed auction isn't just a failed auction, it is really painful for the sellers during that failed auction. Really painful for the sellers. So it becomes even more painful the longer the price rotates inside this little bracket area. It becomes really painful for those guys. So we have to try and recognize that pain and then take advantage of it. It doesn't have to always come from failed auctions, but it can be coming from a failed bottom edge where we get a pin rejection. The market makers are adding actual prices in, and the sellers are going to get pressed, and the sellers are going to be under serious pressure, and we're going to push them over. A couple of examples. Now, what does this mean? It means that when you start trading things like tipping prices, trading a market rally, trading back down again, and trading back up again, there's always going to be a price somewhere in here. There is a great price to buy when the tipping price becomes so painful for sellers that most of them just chuck their positions. And it's always around about that little bit above the POC of those balance areas. Just that little bit above a POC. You start to be able to pinpoint that tipping price that suddenly becomes an incredible place to start doing safe trades. Because if you don't like fading bottom edges, I get it, I understand that. We try and avoid fading bottom edges, certainly in the early stages of learning. And we try and encourage people to avoid fading bottom edges, certainly in the early stages of learning. And we try and encourage people to buy when you know there's a lot of pain by the sellers in certain locations. When we look at something like the S&P in this instance, and we start saying to ourselves, okay, we understand the tipping point. We understand the idea of the tipping point, but let's take a look at some value narratives. When we look at some value narratives, we can look at the tipping price inside these value narratives, and we can start recognizing some of the key structures. So with the price coming down into this area here, and what we've got in this chart is a very simple representation of dealer liquidity. In other words, if the two lines go green, the dealers are adding liquidity below the market. Now that doesn't mean the dealers are going to stop the price. The dealers don't necessarily try and stop the price, but what they are going to be doing is simply adding liquidity. So if they're adding liquidity, they're adding into the bid at the bottom edges when this is green, when you see that histogram is green in the background, they're adding bids into the bottom edges. We can start looking for that bid. We can start benchmarking that bid in that area. And obviously we know that the sellers who are now starting to get jammed at the bottom edge, well, we know what's going to happen to the sell side when the sellers get jammed at the bottom edge. The pain is going to become incredibly severe for those sellers, especially since the majority of sellers into a bottom edge are algorithmic. They're short-term traders. They have a very short window of attention. And as soon as they start getting put under pressure, they'll be gone, guys. Fast as you can say, booyakasha, right? So obviously what happens is we start recognizing some key levels. We start recognizing where that pain is going to grow. We can start to recognize this very substantial change in how the market maker is dealing. They are adding a lot of bids at the bottom edge. So what we're starting to recognize is the ability when the price starts to flip over some of this tipping point. Remember, it's going to be above the halfway stage, right? So we can see that there's a red candle, and then we come up into that little balance area. So if you're trying to get in early into this market maker's bottom edge without fading the bottom edge, there's a great opportunity to take advantage of that trade right there. This is a 30-second chart on the S&P from the 19th of August. So you can see we're not having to go back too far in terms of cherry picking some great examples for you to start recognizing just how good some of these opportunities may be. You know, the market maker sometimes is right on tune. There's no opportunity, and we just wait for the opportunity to present. A bottom edge like this, with the market maker adding liquidity at the bottom edge, well, of course, it would give you an opportunity if you were so inclined to start bidding the downtick phase, but that might not be your style. That might not be something that you want to put into your trading arsenal just yet, is that downtick, but you're certainly ready with your buy stop order to take advantage of that squeeze, and sure enough, that squeeze was worth $500 per contract by just recognizing the quality of that trade. Now, at the top edge, you can see that we start seeing some sell pressure coming in from the market makers here. We saw a very, very fast, aggressive sell-off here, and we can see the second sell-off coming in. The market maker is withdrawing the bid and starting to add to the offer. So they're starting to add to the offer. So there's now two pieces of information here that tells me that there's a top edge coming out. Now, at the very bottom edge, you can see that we see this very, 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 very aggressive, what we would call aggregation liquidity in that environment. Well, an aggregation in that environment, which we didn't have, to be fair, during this phase, the aggregation, which is the two red lines here, and then the aggregation we get on that one, tells that this is a great opportunity to fade the S&P on the way up, because the market maker's evidence is now very, very strong that they're adding offers. So when we see aggregation coming into this area, we know that we should passively work our offers into this print, just like the best floor traders in the world would do, because they're starting to see the price getting jammed. They're starting to see the aggregation, which is normally going to be commercial interest. So when you get commercial interest tying in with market maker interest, the algorithms haven't got a chance. The algorithms haven't got a chance. Now, obviously, if you want to wait until the price then has a failure, then of course you're starting to wait for perhaps a retest up at the highs here, and then you're going to join back in for the swing back away from those prices. I obviously look at this as an idea, and obviously you see you don't get much of a response, but you're not going to lose any money, are you? That's the one key aspect of this. You're not going to lose any money if you sold here. The maximum drawdown you had at that stage was a sell at 31.75. It traded 32.75. It was 4 ticks, maximum drawdown on those two passive sell opportunities. Pretty good trade, right? Pretty good trade. Now, when we talk about benchmarking, this is the key to benchmarking. You can see how good those trades are. When you start casting your eye across the rest of the screen, you say, well, that wouldn't have been a trade, and that wouldn't have been a trade, and that wouldn't have been a trade, and that wouldn't have been a trade. So these really become the ones that you start really focusing on. What made those trades massive winning trades? What made them massive winning trades? Well, we can see what made them massive winning trades. There are a series of characteristics about a winning trade that stand out very, very, very clearly. The idea of aggregations aren't available on this one, but there was some aggregations prior to this. In this area here, you can see that, for example, we had a solitary aggregation right there, which is a passive buy trade. Now, it was obviously they were adding liquidity on the market maker side as well. So when they're adding liquidity on the market maker side and we get aggregation, the chances of you losing money in that trade are pretty slim. It's a passive trade. Remember, it's a fade at the bottom edge. And obviously, we can see the fade at the bottom edge was at 23. The high price was 24.75. You got 7 ticks out of it. I'm sure most of you guys, if you got filled and you got 7 ticks out of a trade, you would easily get a stop at break even +1 and make $10, right? Minus commissions, of course. You make your $10 and you say, okay, fair enough. It doesn't always result in a market reversal, but if I can go in knowing confidently that this is a floor trade that I want to deal, is that not a massive starting point to get started with in your trading? Are these the kind of trades that you look at and say, as soon as I see it, I just want to be dealing? Just like Charlie D. He sees it and he deals. And sometimes they break and sometimes they scratch. And sometimes they actually do lose 2 or 3 ticks. I'm sorry, but they sometimes lose 2 or 3 ticks as well. But if you're trading comfortably and confidently, the thing that you'll find is that on those odd occasions where you get the big breaking move, you're more likely to be in it if you deal more, right? If you deal more, you're more likely to be in the market when the market breaks. You might say, but if you deal less and you leave it for longer swings, you'll always be in it. Yeah, that's absolutely true. But to leave it in for longer swings, you've got to have bigger stops. You've got to have a smaller account size in terms of trade position size, or you simply have to have a very, very large account to run multiple positions into those areas. So, okay, fair enough, that works, right? But we can obviously work around that. And the way we like to try and get people to do is basically trade more often. So you can see we get aggregation, but you can see that that aggregation takes place when there is no seemingly agreement from the dealers. So you say to yourself, okay, so that's just profit taking, right? So the aggregation is not new buying. So when I see this double here, I say, well, there's a profit take here, and you might decide to buy for a scalp or whatever, but you see it doesn't play out. And there was another double here, and it was very red at that stage. And again, the very next candle does go back up again here at 1955. And again, you could have made some money on that double aggregation, but it again would have given you a stop at break even, worst case scenario, and maybe a +1 if you wanted to. But they're obviously not benchmarks, are they? They're not benchmark trades. They don't stand out and say, look at me, get me on your list because I am the best trader on the planet. Whereas this is a benchmark down here, and this is definitely a benchmark up here. Massive difference between those two trades, right? If we go backwards in time, we can start to see other examples of possible benchmarks. Here's a great example of a bottom edge again. You can see the aggregation is already in. Now, why is that important? Because most aggregations are profit takes. There's not an awful lot of aggregation a lot of the times during these exhaustion prints, because exhaustion obviously is the exact opposite of what aggregation is. Aggregation is a lot of activity at a set price. So when I see how red this area is, and I see this period of aggregation here, that's the profit take by the sellers, right? Well, if that's the profit take by the sellers, and I see the price then drifting off, I'm looking for the first time of any buyers coming in, and the first time any buyers came in was here. You can see that it goes 2 candles to the right. So there must be some buyers came in here. So there was no real evidence of buyers during this down phase that we can see just ahead of that. So I draw a straight line. I can see the market makers are adding liquidity. This is not a lagging indicator. This is not a lagging indicator. This is real-time derived information, right? So the market makers are adding liquidity here. So we can understand that. So we can understand that we've got the aggregation. Now we can understand the market makers are heavily bid at this stage. And I start watching for a possible bottom edge. This looks almost exactly the same as the previous one. You can see that it's benchmarkable. The two market maker indications are both green, solidly green. And we're into a bottom edge. There is very little as good as that opportunity to take advantage of. If we got an aggregation, it would be delicious. But a lot of times we're not going to get that aggregation. So we have to remember that part of our benchmarking is to make sure that we see some aggregation so we know that at least the profit take's already out. Because obviously if it hasn't been taken out yet, the profit taking needs to come out first. And why is that important? Because if the profit taking hasn't came out, they want to take profits on downticks. They don't want to start marking anything up yet. So we need to see that aggregation. So whilst this aggregation is not part of that benchmark there, it is actually part of the benchmark. Without the profit take, the price will keep dropping. And the reason for that is because the accumulation takes place in a passive manner, and therefore it should be at lower prices. So if we haven't got the aggregation, it's still to come. Usually we have to give it a bit of time to allow it to happen. It has a lot of cappers in place. It's not the biggest trade in the world. It goes from 29s to a high swing eventually of 34s. It's still 5 points, guys. 5 points, $250 over a period of 12 minutes. Nice floor trade. Nice floor trade, right? Let's carry on backwards because this is obviously, as I said, this is Friday. And again, we're looking for that idea of aggregation. And we can see that there's a great example of what I'm talking about here. You might be saying, yeah, but wait a second, Ray, this is a sell. Is it a sell? Is this trade here a sell? Well, we've got, everything's gone red. The market maker's adding offers. Yeah, but where's the aggregation before it? Where's the aggregation in here? Where's the red aggregation before it to tell me that the buyers have already started to close out their positions. It hasn't happened yet, has it? So in other words, the lack of the aggregation tells me that this is not the sell trade yet. That little piece of inside information tells me that the market makers may be adding liquidity, but not to the extent that we're seeing the aggregations at any stage so far. So I'm not going to be selling this. I am not going to be involved in this trade here. And I am going to wait for some sort of aggregation and then rejection top edges. And you can see that there was an aggregation on this candle here, which may have got you interested. There was an aggregation there. I don't like it personally because the spike in the green and the turn in the red, there's a lot against that as an aggregation. So I would draw another line and I'd start looking for possible sells against that line. This one looks a lot better. This aggregation here looks a lot better because everything has obviously just calmed down. We've now got a new high. We've got a level 2 liquidity. I can start working some offers against that type of idea. But just take a look at that little tiny piece of inside information. The little piece of inside information that there hadn't been any profit-taking aggregations in the way up, suggesting that it still was to happen. It's still something that needed to happen in the sequence of events to allow us to have a safer top line sell. That simple piece of inside knowledge keeps us away from selling too soon, getting trapped in a bad sell, and then losing money on a trade. That massive difference in opinion. If we look at the buy trade at the bottom edge, you'll see the exact opposite to what just happened on this trade. We see a massive aggregation, and then we see a bottom edge retest, allowing us to buy safely. Take a look at it. Do you see the aggregations coming in big and strong? So we get a massive amount of volume coming in these 4 candles. Now, I'm not saying the market maker is massively buying these, but somebody's massively involved in these candles. And then it stops at this price. Now, that doesn't matter to us. We're not buying it anyway. We wouldn't be buying it because we haven't seen any liquidity coming in, right? But obviously, we've seen this maximum liquidity at the bottom edge. How do we know that? Because the price went up. So obviously, there was enough buying coming in at that price area there to force the price back up again. And you see the market makers poured in on the bid. They poured in on the bid here as the price retested that area. Now, obviously, it's going to be a challenge to find the exact turning point in this trade, so I'll just put it in at the best possible price. Yes, cherry picked, absolutely. But you would see that it'd be very difficult to get much further away from anywhere. Would have been a pretty good price, right? Any break of a little key level, which the last key level was our price of 30.5, so either your buy was going to be at 30.25 or 30 point evens. There's only 2 ticks difference. So whatever you got, you can see you made a very, very strong trade to the upside. Again, tying aggregation and then tying exhaustion into that aggregation, tying in the market maker, adding bids to that bottom edge, and taking the market away from that price, allowing you to trade the benchmark. Now, obviously, this is all about benchmarking. This idea is benchmarking, benchmarking, benchmarking. Here's a great example of a kind of, unusual trade at the top edge here. The reason why it's unusual is because obviously the market maker had been adding bids, but you can see that the slope of the 2 lines are both declining quite aggressively. And obviously that means that they're pulling away their bids and they're starting. You can see that we started to see some offers getting added in here, and we saw an aggregation at the same time. So this is one of those rare events where we actually get the aggregation at the same time as that market maker activity. And that gives us a very, very, very strong benchmarkable sell trade. You can see that benchmarkable sell, close of the candle. You're saying to yourself, that's it, that's the price, that's the one I want, that's a benchmark. Because you don't have to find a trade at that stage, it's found it for you. You're able to lean against that 46s, and obviously if you were able to hold on to that short trade that traded all the way down to 34s for 12 points, $600 of potential profits. So you can see we're just scrolling backwards through a whole day's worth of data here. But the idea is that when you scroll back over a whole day's worth of data, there's not trades all over the place. There's not opportunities everywhere. You're starting to look for the right things at the right prices. The difference between that sell trade there, for example, and this aggregation here is quite dramatic. You can see that the market makers were bid, and they've started to come quite aggressively off the bid. You might be looking at it and saying, but they were still bid. They weren't offered at that stage. Well, if you thought that that was, if you were happy with that narrative, if you're happy with that storyline, you'd have been able to buy into that aggregation. Well, guess what happened? You went from 39 to a high price of 41s, and you made yourself $150 for your troubles. It only took you 1.5 minutes to make $150. So again, it might not have been the perfect aggregation, and that's the point I'm trying to make. Not every trade is a benchmark. If you have such a high threshold for your benchmark trades, you might find that you do very few trades. You might find that you do very few opportunities. But obviously, one of the key aspects of benchmarking is you start to list and learn about the things that go into your benchmarking. So whilst a benchmark might only happen once a day, it's nearly a benchmark. If benchmark is 10 out of 10, this is a 9, or this is an 8, or this is a 7, it's still good enough to maybe do some trade. If you're a multi-lot trader, what that means is you can simply change the amount of size that you're going to be trading on a particular situation. I had a bet on Saturday on a horse, and I couldn't believe I was getting 7-to-1 odds. 7-to-1 odds, 7.0, 8.0, 7-to-1 odds. And I looked at it and I thought, this horse will not be out of the top 4. It won't be out of the top 3, I don't think. And at 7-to-1, I can still make a profit on an each way bet. I did my numbers, I crunched my numbers, and I crunched them again, and I crunched them again. I've never seen a horse as good at such a price. And I just put literally a fortune on this horse at 7-to-1, and it won at 7-to-1. It actually won the race at 7-to-1. I wasn't expecting it to necessarily win. I just knew it wouldn't be outside of the top 3. But obviously that's an odd occasion. I haven't seen a horse as good as that in terms of its numbers, its performance, and its ratings for years, literally for years. That's a benchmark. Now, I would put a lot of money on that. Now, the problem is the horse could still throw a shoe, right? The saddle could still slip. The horse could get boxed in. The horse could pull a tendon. The horse could have a nosebleed. A lot of things can happen in a race. We know that. So there's no dead certs. And the same is true of trading. There's no dead cert that if I was to sell into that aggregation right there, knowing that the market maker was offered, that the price would sell off. But I'm stacking a probability here. It's about stacking a probability, knowing that if I have those lines selling off and I'm still able to get a good price and I get an aggregation, the probability is starting to become pretty high. I'm going to make some money. You can see there are an awful lot of swings. So you can see, for example, here, you can see this very, very strong swing. The green line is still very, very high. It's still very high. And this is a lot lower than it was over here. So I'm not looking at that from the aspect of this is an absolute given that this is going to sell. But even if I thought it was, and I took this double aggregation there, look at what happened. If I took that double aggregation sell, I was able to get a sell in, I still made money. And it didn't drop, but I still made money. I still was able to give a stops at break even. So worst case scenario, I still take a +1 out of the trade. It's still a green number in my account, right? And then we get another aggregation in a slightly better position. And take a look at what happened. It was effectively the top tick price. We're selling into the top tick price there, and you can see that within a few minutes, we'd had a very nice, easy money sell away from that price. The probability was starting to stack up in my favor. And I'll show you a perfect benchmark that took place just before those sells. It was the buy side of the trade. Look at the buy side here, guys. So we started out with an aggregation right here. So we can see that it's still very, very strongly red. Still very strongly red. In other words, the market makers might not be adding new offers, but they're certainly withdrawing offers when we get this green aggregation. So we say to ourselves, well, it could be a buy trade. And if you took it as a buy trade, yes, you made money. But obviously what happened was the aggregation led to a bottom edge. And then you saw the market makers adding bids. They added bids to the bottom edge. And you're saying, well, we've already had the aggregation in the background. Now they're adding bids to the bottom edge. I think I quite fancy a buy opportunity now. This looks like a benchmark to me. Buying into that price there, damn tootin' right, it's a benchmark. And sure enough, you went from 33.5 to 41s. You made 8 points, $400 profit. And it took you 6 minutes. 6 minutes of effort to get that money in your bank account. That is a benchmark. Now, what I'm hoping is that you're seeing that these benchmarks are visible. The idea of benchmarking is visible. It's something that, it's not just me that's telling you, it's on your screens there. You can look at that and say, could I use this? Could I make sense of that storyline? Does that storyline give me a narrative? Like I'm standing on the floor of the exchange, seeing the bids and the offers coming in, seeing that aggregation on my screens, and taking advantage of an opportunity to layer some trades into those areas. I could make some money with this. This isn't as subjective as I thought it was going to be. There's a lot of ability to really start driving into the high probability trades rather than the very average probabilities. I'm not saying you have to take the bottom edge trade. We talked about the tipping price, of course, and we can see that into this little balance area here. You can see that there's a tiny little balance area there. The tipping price would have meant that I don't have to buy the bottom. I could have started to bid somewhere into this area here, and knowing that if I can get filled into that price, high probability is now starting to stack up. The price is going to break north. Because as soon as that starts to uptick, the sellers start managing to just say, what the hell, I'm in the wrong trade. And if you haven't yet broken north and the market makers are adding even more bids through that process, you're saying, I am not going to lose this trade. And you can take advantage of that pop right there. Now, I'm showing you a lot of trade opportunities potentially during this phase. How many of these trades do you have to take to justify coming into this classroom, guys? How many of these trades a day with a one lot do you have to take to justify what you're going to learn in this classroom, to justify the cost? And everybody knows that it's a hard thing to decide to do another class when you've done so many in the past or read so many books, and you still just, the reason why you're here is you must be thinking to yourself, there's more to it than this. There's more to it than, it can't be GAN. GAN can't be right. Fibonacci can't be right, and Elliott can't be right. Common sense tells you it can't be right. So when you understand, right, common sense tells you it can't be right. So when you understand that, when you start to make that inquisition, you start to challenge that, you say, this intuitively, I just think there's more. There is more. It's not that there's more, there's just correct and there's not correct. There's the stuff that sells books and there's the stuff that makes you money in the markets. And they're not the same thing. The stuff that sells books, the stuff that sells courses, the stuff that sells webinars and all of these kind of things, the stuff that sells those is giving you guys an easy option. And you all love it. Oh, I want the easy option. Well, I've got a solution for you. Whereas I have no solution for you guys. Because there isn't an easy option. You got to put in the graft. You got to put in the time. You've got to learn something. You've got to learn to do it for yourself. Take responsibility and stop letting somebody else tell you where the trade is. Find the bloody trade yourself. It's easier than you think. Generations of locals who have came with no education, no PhDs, no MBAs, no BAs, no BScs. Thousands of locals have gone through the floor of the exchange, and many of them have made millions of dollars with no formal education at all. Just an idea that they have an ability to get into the noise and sense what's going to happen next. So you don't need to be well educated. You don't need to have all those fancy degrees hanging from your walls. You don't have to be the guy that thinks he knows everything. But you need to be the guy that knows where the real money is. You've got to be the guy that knows why the real money is going to deal in certain locations. And then when you know that, you start looking for it. You start saying to yourself, where the hell even is it? I know there's going to be real money coming in. I know that there's going to be an opportunity. So where is that opportunity? Where am I going to find that trade? And we go through this through our benchmarking process. Now, the way we're going to present this class is we're going to present this class very, very quickly into an idea that what we've got to try and do very, very quickly is get you up and running. I'm always aware that it takes a while for people to really get to the nub of the trading ideas that we teach, to really get into the trading ideas, to really get to that point where you can say, oh, well, where's the trade? I know where the trade is. I'm going to take a trade from, from literally 2 minutes into doing this classroom, and I'm going to start making money very, very quickly. So what we're doing this time around is we're going to teach the quick starts in the first month. In other words, we're going to teach the fast stuff in the early part of the phase of the trading sessions. We're going to teach the fast stuff to get you up and running and hitting the markets as quickly as possible. And then we're going to do all the other stuff, the stuff that adds an extra small edge and an extra small edge and an extra small edge to your trading in due course, but not over the course of the same week, because we want to get you up and running, and there's a lot of people in different markets trying to find different tradable opportunities in those areas. So we need to get you up and running as quickly as possible into a trade. And that's what we're training. Well, that's my suggestion to Kim from the format of this is to get you into the quick starts as quickly as possible. In other words, get you reading value, get you reading price, get you reading volume, and starting to make trades and starting to think about the demo in your account, starting to get your demo up and running, starting to get your demo making money, and then starting to get a live account and making money as quickly as possible so that you're not having this downtime during these trade ideas. Now, this is obviously something that you can look at over the course of the 16 weeks. The idea of being able to look at the markets in terms of finding some great trades and in some great locations. We've talked a lot about oil, for example. I want to show you a good example of what I mean by this. Now, one of the things that you'll learn about trading, what we trade in oil, is you look for what we call value bubbles. And we look for something that stands out in terms of a benchmark value bubble. We've got a lot of ways of looking at value, and I want to just look at this series of lines here. Now, there's no price on this. There's value on this. Now, you might look at it and say, it's just a mess, it's just a noise. No, when you become trained about what we're showing you here, you'll be like, this pings out of the charts at me. So when I look at this, I look at a couple of things. I'm looking at this area here. And I can see that there's a very, very sharp reversal off that area. Very sharp reversal. You might be saying, but there was a very sharp reversal off it before at this stage here. Yeah, but there was no value. And there's no value because you can see that the shape of this going into that area is slightly different from the shape of it going into this area. The other thing I like about this is the volume at this stage is actually completely dropping. And what that means is that the buyers are giving up. And then I see a increase in volume on this candle. There's an increase in volume on that candle right there. And when I see that increase in volume on that candle, that to me is what I call a benchmark aggregation. I can look at that and I've got a 99% probability that if I sell the close of that candle that I'm going to make money. Literally a 99% probability, guys. If I sell the close of that candle and it's on that little puff of volume there, I will make money. I might only make 5 ticks, I might only make 10 ticks, but I'm going to be in that trade every day. Every time I see that, I'm going to be in that trade. Let's see what happened to that trade right there. I've just put an upright line on the charts so that you know that you would be able to see that trade in real time on the right-hand edge. That trade was a sell at 91.62 and it traded down very quickly to 90.70. Nearly $1,000 in a period of 1 hour. $1,000 a contract in a period of 1 hour. And being able to recognize the value that was in this is at really the core of all trading. Because when we think about value, the narrative behind value, this is what we get. This is what we get here. There's 3 cornerstones to everything we do in trading. Volume is what you get when price meets value. Right? Value is what you get when volume meets price. Now, I'm going to put in a couple of caveats to this whole narrative. And price is what you get when volume meets value. So you can see there's 3 components. There's price, there's volume, and there's value. So one of the things that we can start looking for is being able to tie two of these elements down and then look for the third. So price is what you get when you get volume and value together. So in other words, when I get volume and value together, I mark the price because that's a commercial buy zone or a commercial sell zone. I get an area on price that I want to deal in this area now. I want to be a buyer in this area when I get volume and value coming into the markets. At that price, I want to deal. That's why we get a thing called aggregation. We've already looked at several aggregations. Aggregation is when volume and value met at a certain price. When we get volume meeting price, we might not know that there's any value, but somebody somewhere must have recognized some value for that. Whether it's enough value to reverse the market or not, I don't really care. If I get volume and price and I don't see any value, somebody sees value. In other words, it's a question. Volume and price meeting each other presents a question. What value are these guys seeing for this price? What value are they seeing? Because I don't see it. So what value are they seeing? Is it just a profit take? Is it a target price? And I can figure out what that value is. I can look around to see if they're using a different driver from me, if they're seeing something different from what I'm seeing. Is it a spread trade, perhaps? Is it somebody that's doing some hedging? Perhaps. In other words, I'm able to ask a question, seek out a narrative, and demand to know the narrative before I make a decision about what that means. And the top one's obviously incredibly easy because this is our signal. This is our signal. So this one here is this bottom one here, this is an area. Okay, this is an area that we get from the charts. This here, this is a question. This is a question we get from the charts. Why, what, when, what is it that's going on? And this is a signal that we get from the charts. So we get this idea of this price meeting value gives us this surge in volume. Why? Because that's what's happening. The price meeting value gives a massive increase in interest by the commercials. The commercials are buying massively amounts, and obviously as a commercial buy massive amounts, the high probability, not always, but the high probability is we get a massive increase in volume. And when we see that massive increase in volume, we've got a signal to go into the markets and find that trade area. So for example, if we were coming down and we see this idea and we start seeing this area and we see the price coming down and we see that the price gets volume, but we don't see any value, well, what is that? Well, we decide it's a bit of profit taking. It's a good distance. It's maybe a wholesale price. The price bounces off of that, and then the price comes down, and what we get then is we start seeing this idea of price is what we get when volume meets value. When volume meets value. And we start to recognize that, we didn't have any idea about this price before. We didn't have an idea that this price was relevant. But obviously when volume starts to come in with a value area being visible, it's starting to create a price area at that stage. We start to pay attention now. And obviously what we're now looking for is a signal. So the price maybe bounces, and then we know that we're getting this idea here, and volume surges on this candle, for example, here, and we start seeing this idea that we've got price and value, and now we're getting volume. We're getting that massive surge in volume. We know that this is a signal opportunity, and we can take advantage of that signal, and ultimately whatever happens next is what happens next. So we started out talking this evening, and I know it's a Sunday night, guys, and it's we're obviously getting just the last throws of the dice to see if any of you guys are interested in this. Kim's obviously trying to put together enough information for you guys to make a decision, and it is a tough decision to make. I get it, but at some stage you've got to just decide that you want to trade the reality of the markets, not the waffle in the sidelines. You want to actually trade the real stuff. You want to learn to be a professional trader. You don't want to be embarrassed by the next best indicator. You don't want to be embarrassed at the next cocktail party that you go to where you're trying to explain that you bought into this system and it didn't make any money again. It was a system and it was a process, and it had Gann cycles and Elliott cycles or whatever else cycles, and it was dead subjective, and it's, you know, they kept claiming they had this great trade and I tried it and I'd never made any money. You don't want to buy into that. You've already seen a week's worth. That was the week you could have had. A week's worth of tweets that made $50,000 per contract maximum swing should you have taken all of them, which you're not going to do, and you're not going to get the maximum swing, so you're not going to make $50,000. But it was at least possible to have made $50,000 had you followed each of those narratives. So this isn't waffle. You can see that what we talk about in a lot of tweets is the reality of the markets. How do you know that? Because the things that we talk about is the same things you hear about on Reuters News, the same things you hear about on every news channel. The curve, the Fed, the news releases, the fundamentals, the data, the technicals, the liquidity that the market makers, the Charlie D's shouting out about the buys and the sell transitions. It's the reality of short-term and the long-term trading. You've seen $50,000 of real trades. You only really have to find one of those trades a week to make the course pay for itself many times over within a week. You have to be able to get up to speed fast. You've got to be able to find your feet quickly. And what we're trying to do in the classroom is get you up to speed fast. We're going to be looking at oil, Forex, the S&P, bonds, and gold. And we're going to try and get you up to speed quickly in each of those markets. Over the course of the next 4 weeks, we'll be focused on one market per session to get the quick start going, get you the benchmarks, the very best of the best, and then we'll start going through the other elements that we can build edges on. But at least you're starting to see the right trades at the right prices using the right concepts as quickly as possible. How quick is quick? Within 2 hours, you should start to be able to be profitable on your demo account because you're finding the right trades without having to worry about stops and all that kind of stuff on a demo account. Within 2 hours of the classroom finishing, you should have your quick start ready to go on oil. And then in the next class, 2 hours, you should be ready to get at least the basics of your bonds right, getting into the right areas. Maybe not the transitions yet, maybe not the perfect benchmark, but at least in the right side of the deal, for God's sake. Having the ability to at least be on the right side is going to eliminate half of all your losses, right? Just by knowing what side of the deal to be on. Being able to eliminate one side of the marketplace is one of the biggest breakthroughs that anybody can ever achieve as a trader. Stochastics and RSIs and MACDs do not allow you to do that. Gann, Elliott, and Fibonacci doesn't allow you to do that. It's just waffle. So what you've got to do is decide to take that chance on something that's the reality of the markets. And the truth of the matter is it's not an easy button. You're going to have to put in a lot of work, but what you're going to get out of it at the end is what you've always wanted. There's a number of clients in this room, a lot of clients in this room say, finally, I've joined a room that actually seems to be the way that the market really is. I'm starting to recognize the reality of trading, not the promises, not the empty gifts, the promises of untold wealth by following this system where I don't know what it is, but if I just follow it with blind faith, I'm delighted. Well, good luck to you if that's the way you want to trade. Alternatively, if you want to really trade the way that the locals trade, the way that the banks trade, the way that the pension funds trade, the way that the hedge funds trade, the way that the market makers trade, there is very, very few places that will teach you the truth. They might know bits and pieces, but they wouldn't know the totality of it all. They wouldn't know how to put it all together as a jigsaw puzzle. And that's the difference, the breakthrough you'll get from this classroom, guys. So I'm going to finish off at that and pass it back to Kim. I don't know what else she's got for you, but I'm going to leave it at that. And again, hopefully you make the decision, you make the commitment. And if you do, I'll make the commitment to you guys. No trader left behind. We will do it until you get it. It's as simple as that. No trader left behind. And we will keep on pressing it until Everybody gets it. It's as simple as that, and it's up to you guys. Right, Kim, I'm finished. I'm out of here, and I'll see you guys tomorrow morning. Ready to start work, guys. Tomorrow morning, ready to start work. Thank you very much for your time, guys, on a Sunday night. And I'm going to say ciao for now.
Thank you so much, Ray. I appreciate you so much. That was fantastic. I think there's nothing else that can be said, but I will continue to answer questions. We are ready to get started tomorrow, as Ray says, in the morning. You gotta be ready to go. I love that we're going to be doing the quick starts to hit the market trading. And if you have any questions, I will be answering them. I will get back over to the slides so you know where to start and sign up. We've already had some say, all right, in the middle of it when Ray was going through stuff, I've seen enough. I'm in. And we want to welcome you guys. And I think what's really important is to look what Marv said. Marv was a student. He's just been in with us since last week. And I think this is really, really important for you to see. He says, the info Ray is giving us, no one else in the market is giving out. In 1 week in class, I've learned more than 15 years in trading. In 1 week, just imagine what I will learn in the 16 weeks. It's priceless. And he's so right. I mean, so many come in, and this, as Ray was saying, his program, Ray is not the easy button, and but he is, if you roll up your sleeves and you get ready to approach everything, you're going to see a huge difference in your knowledge, your understanding of the markets, your approach, and he's going to help you understand where you are in the game. I think most people don't know where they are, and the markets are a game, but you got to know what game you're playing and what player you are, and you got to match those things up correctly. So that's what we're going to spend the next 16 weeks doing, and we're starting that tomorrow, Monday, August 22nd. I'm going to go ahead and stop the recording, and then I'll answer questions. We hope you will join us. If you're just listening to this recording, because we'll send this out, it'll probably be up tomorrow so that anyone can listen to it again. But I'm going to go ahead and stop the recording. Fantastic session. Can't wait to get started with our new Smart Money class.